This conference will now be recorded.
Since you all didn't remind me, but this is pretty standard, but we'll start recording now. The industry practices constraints. Sometimes there are special rules in industry. The energy industry has special rules in terms of revenue recognition, insurance companies, banks. So sometimes industries do things specially, and sometimes it gets the energy industry in trouble. But once they get the crude and refine it, they have a tendency they can mark it up because it's going to sell right away. There's a ready market for it. But we do have to be careful with that. Consistency, you got to use the same principles every year. If you estimating your bad debt as a percentage of sales, you got to always do that. If it's a percentage of the balance in the receivables account, then you got to do that, but you can't switch back and forth. And that'll be especially true as we get into inventories. We want objective records. There needs to be objectivity. So you got to have documentation on what's happened. You don't just guess about what it is. You got to have evidence. So if a financial transaction occurred, there should be evidence of it. Accrual basis accounting. We recognize income when earned. We're a very, very small business. Business might be recognizing cash when it comes in and recognize expenses when paid. But if you got inventories and you're doing a lot of work, that's not going to be a true reflection. So accrual basis accounting is required where you recognize income when earned and you can accrue expenses even if you have not paid them. And our final principle is the assessment of cash flow prospects. Assessment of cash flow prospects. Because we're using accrual basis and we're selling on account and we're making entries to recognize revenue, journal entry 15, type 15, before we get the cash, we still got to be sure we got enough cash in the business. And so this is where the statement of cash flow comes into play. The fourth statement, we have to be able to assess, we have to be able to pay our bills. You may have very good prospects of income that you're going to receive. But when September comes, Texas Southern wants you to pay your bill. And so the fact that you got income coming in, they want the first 50% now. That's the only way they're not going to kick you out of classes. So you got to have that cash. And so when we're looking at a company, the company's got to be able to pay its employees, it's got to be able to pay its rent or it's going to get kicked out. And so we prepare that final statement to make sure that the company can pay its cash obligations. So we'll be looking at that statement. Okay, so we got these definitions you should be familiar with. We've looked at most of these, so you should be familiar with these. So they're just here for reference, but those 15 principles are the key thing that you have. A and B students, our financial statements will now begin to look like these statements as we prepare them this week. Next week, sales less cost of goods sold, gross profit less operating expenses, net income before taxes, net income after taxes. So this is how I want your financial statements to begin to look for the A and B students. The statement of retained earnings stays the same, beginning retained earnings, that net income, less dividends, ending retained earnings. But then on the balance sheet, A and B students, you got to separate it. You got the current assets, and then you have the fixed a long-term asset for total assets, you got to separate between what's current and what's fixed. Same thing with liabilities, what's current, what's long-term. Current assets are assets that are going to convert into cash typically within 1 year. So cash is the premier current asset. These other assets got to be changed into cash in 1 year. The fixed assets convert to cash in longer than a year. Current liabilities, they are due within a year. So anytime bills are due within a year, they're current and you list them as current. Long-term liabilities are due in a period of time longer than a year. And then we have our common stock, additional paid-in capital. Sometimes, stock is issued at par value, and if a person pays more than that, that's where the term additional paid-in capital comes in. And then that all-important concept of retained earnings. And retained earnings are either debit or credit. So, students, I do not want to see any more minuses in those closing entries. They're either debits or credits. And I'm going to take out major points if you got a minus on those entries. So every time you got a minus in a journal entry, that's a minus 10 points. I don't want to see minus signs again. So I'll lean in. But this is the third time I'm telling you. So 3 strikes you out. No more minus signs in journal entries. Work through that. And of course, total assets has to equal total liabilities plus total shareholders' equity. So these 2 things have to equal. So A and B students, this is how I expect your statements to look. Here's some multiple choice questions that are in the primer for you to practice on. So you'll be ready for these by Thursday or Friday. Okay, the accounting cycle. We started off with steps 1 and 2, analyzing transactions, making journal entries. Then we did steps 3 and 4. We posted to the ledger and we prepared a trial balance. And then because steps 5 and 6, you're not told what the dollar amount of the entry is. I just went to steps 7 and 8 and let you prepare financial statements and close the books. So now we're ready for steps 5, 6, and 9. And in 5, we make adjusting entries. Then in 6, we prepare an adjusted trial balance. That's not necessary. You can just prepare the trial balance after the adjusting entries. So we make regular entries and then we make adjusting entries. So adjusting entries are journal entries. And every time you make a journal entry, just like with closing entries, you post them to the ledger. So you always are going to post those to the ledger. Here are our journal entry types. And in that first journal entry, we always debit cash and credit common stock. And so I would take my ruler and hit somebody's camera, but I might not be able to get back. But one person is still messing up on this first journal entry. There, put the common stock on top and the cash on the bottom. And we always put the debit on top and the credit on the bottom. So if you miss this first journal entry, that's a minus 10 points from now on for anybody. If you missed the first journal entry, That's a minus 10 points.
Aren't these punishments like too much for a summer class? How are we gonna get these points back?
You got to stop making that mistake. So I'm giving you enough time to not make that mistake. And so you look to see if you're making that mistake and don't make it. I do give you, I do give you 110 points every time. So I'm just taking back my 10 points that I give you. So you always got 110 ways to get your 100 points anyway. But you got to be listening to what I say. You need your screen on and paying attention. See how?
I'm getting to it. I'm getting to it.
You can't be there playing computer games and stuff like that and not have your screen on. That's why that happens. Now, notice that A students will have current assets and long-term assets. That's right here in the chart of accounts. You're just making that separation now. Current assets, long-term assets. Current liabilities, long-term liabilities. And then the stockholders' equity. And remember, the balance sheet stops at retained earnings. Even though dividends and income summary on this left side, the balance sheet stops here. And so all of these accounts, dividends, income summary, and every account over here is a temporary retained earnings account. And when we make those closing entries, we close out 455 all the way to 705. So at the end of the period, 455 to 705 are all closed out. Okay? And I got these normal balances. And I'm kind of tired of seeing account receivable with a credit balance by some of you. So how many points do I need to take off of you if you got account receivable in there with a credit rather than a debit balance? Sam, how many points I need to take off of that?
1 is fine.
What is that? Okay. Any questions so far today? Any questions so far today on anything I've said? All right, time for adjusting entries. And at times, we're going to have problems on adjusting entries because you're not told what the amount is. You're not told what the amount is. So this is a nice little summary. I said this to you. You do need to read this. Let's talk about the rationale for adjusting entries again. We have been buying supplies. We bought $1,000 in supplies, and then we bought $8,000 in supplies. So we got $9,000 in supplies now. We bought $1,000 paying cash. We bought $8,000 on account. These are kind of preceding entries as we're looking at adjusting entries. And if we come to the end of the period, and we're told that we only got 3,000 in supplies, not 9, then we've got to make an adjusting entry. We got this listed as an asset. It is now become an expense. And so the adjusting entry is not the amount in the account is the difference. So if we had 9,000 in supplies, and we got 3,000 left, the adjusting entry is the difference. So it's not the balance in the account. It's the difference between what was in the account, 9,000, and what's left in the account, 3,000, 6,000. So we have the entry. Everybody know how to buy some supplies and pay cash, and they know how to buy some supplies and buy them on account. But when we come to the end of the period and we determine that we only got so much in supplies, our rationale is like if we had 9,000 in the bank at the beginning of the period, and we got 3,000 in the bank at the end of the period, we must have spent $6,000. And so we make the adjusting entry, debit supplies, expense, and credit supplies. So now we moved it on the expense side. And expenses reduce revenues. And so you don't just go out and buy stuff when you're running a business, because those supplies are going to eventually turn into an expense. And the expense needs to have generated some revenue. So hopefully that gives a sense. We buy the supplies, then we use them up. And we could record it every time it happens, but most time we're just going to say, okay, we had $9,000 worth of paper and pencils, staples and everything. Now we got $3,000. We must have used 6,000. Is that adjusting entry clear to everybody, especially A and B students who missed it? Okay. Any questions? Okay, we have 4 types of adjusting entries. We have unearned revenues and prepaid expenses. These are deferrals. Then we have accrued revenues and accrued expenses. These are accruals. With a deferral, a cash transaction occurs before this entry is made. With an accrual, a cash transaction occurs after the adjusting entry is made. So just remember that. Deferral, there's a cash transaction that's occurring before. Accrual, there's a cash transaction that's occurring after the entry is made. So the 4 types of adjusting entries, we have prepaid expenses and unearned revenues, accrued revenues, and accrued expenses. So with our C students, we'll work on these top 2. Now, A, B students, you need to be able to do all 4, but we don't want to over involve our C students, so over frustrate them. So they, as we go through these, they only have to do the top 2. Let's look at these important rules for adjusting entries. First one, cash is never involved in the adjusting entry. I'm going to say it a second time. Cash is never involved in the adjusting entry. And now I'm going to say it third time. Cash is never involved in the adjusting entry. So you got your 3 strikes, Sam. I said 3 times. So you might have cash in a preceding entry or succeeding entry. but never in the adjusting entry. Secondly, adjusting entries are going to involve a revenue account and an expense account. It's always going to involve a revenue account, or an expense account, and a balance sheet account. So in other words, there's always a balance sheet account and there's always an income statement account. And something is on that balance sheet account that needs to be reflected on the income statement. So the income statement will be correct and the balance sheet will be correct. So there's always an income statement account and there's always a balance sheet account. And eventually I will look at a chart of account that works with that. So we're going to look at the easiest one, which is unearned revenue. A lot of time things happen where people pay for stuff in advance. You got to pay for airline tickets in advance. You got to pay for magazines in advance. And sometimes if you want something like some special Jordan shoes or a special game, you got to pay for it in advance. Okay, because you want to make sure you get it. So let's assume GameStop collects $50 in advance from 200 customers. So these people want this game, they got to have it. Only 200 coming into the store. And so 200 people go in and pay $200. Well, GameStop's very happy. They got their money in advance. So how much money does GameStop have? What's 50 times 200? That they got $10,000 because you got to have this game. Now, we're going to debit cash, but we're going to debit credit unearned revenue. Okay. So this is the preceding entry, unearned revenue, and debit cash. So in these entries, we got the cash first. So GameStop's like this. What type of account is unearned revenue? What type of account? It's a what?
A liability, a current liability.
It's a current liability. Why? Because GameStop has not earned the money yet. So they can't recognize the revenue. It's unearned revenue. You can ask for your money back or whatever, or they may not deliver. So they debit cash and they're happy, and they credit unearned revenue. And so what type entry is this we making?
4.
Type 4. Now, then suppose all of the people go and pick up their games. Then here comes the adjusting entry where we debit unearned revenue and credit sales. That's a type what?
I'm sorry.
18? Yes, what's your question?
Yes, because for that one, I actually use transaction type 20, which is the unearned income in the sales. Unearned income is debited.
Old number here. This might need to be 20.
Okay. Just trying to make sure.
Probably a better number. That's probably about the old one. But it's nothing hard about this adjusting entry. Okay, you get the cash, you debit cash and credit unearned income. And then when you get when the people pick up their merchandise, the company debits the unearned revenue and credit sales. So the unearned revenue is going to be a liability account. But when the company wants to prepare, it wants to go ahead and deliver the gains, but it is happy it's got your cash. But it wants to recognize its revenue so its financial statements will look good. Okay. So that's all involved in that adjusting entry. That is all that's involved. So I'm sure most people in here pay things in advance. So debit, cash, credit, unearned revenue. And then when the goods are delivered, we debit the unearned revenue and credit sales. Everybody make that entry? All right. Don't worry, you will be assigned one for tomorrow. So there are 10-point adjusting entries you make tomorrow once I get them assigned to you. So C students, you should be knowing right away, hey, this is an adjusting entry I might get. Let's go to some that our upper level C students will get, and then our A and B students will get. So in the unearned revenue, we got our cash in advance. We did the work and then we earned it. With prepaid expenses, we pay the cash in advance. Now, we either credit cash or we credit accounts payable, but we got to pay the account payable eventually. So just by every asset, once you get past receivables, is a prepaid asset. Well, we debit the asset when it's acquired. So you either credit cash right away or you're going to credit cash later when you pay the account payable. So we buy the asset, but it's a prepaid expense. Eventually, it's going to make its way to the income statement as an expense. It's like we talked about last time. You buy those steaks, yeah, they're supplied in your refrigerator when you buy them. But once they're eaten up, they're an expense. Okay, prepaid expenses, you either use them like supplies or they expire with time like prepaid insurance. If you don't make the adjusting entry, assets are overstated and expenses are understated. So if you got the supplies on there and they're gone, then you got your assets overstated and your expenses are understated. With insurance, we always are basically debiting prepaid insurance. Then we make an adjusting entry because when we buy the insurance, it's an asset. Then those autos we've been buying, they're prepaid asset, which we have to depreciate. So let's go back to supplies and let's see if we can handle supplies again. So we're looking at assets and we're making adjusting entries. So it says assume supplies of 5,000 are purchased during the period. We do inventory, we got 2,000 at the end of the period. And suppose we pay cash for these supplies. What would be the journal entry to buy the supplies? Debit supplies and credit cash. Any problem with that? But now we take our inventory and we only got 2,000 in supplies. So we got supplies sitting in there in our tier account of 5,000, but it's actually only 2,000. So what adjusting entry are we going to make?
13 supplies expense. and supplies, like you're gonna debit supplies expense and then credit supplies.
For how much, Chris?
3,000.
Thank you. Okay, so we're gonna take that difference. So we bought the supplies, type 7, debit supplies and credit cash, or it could be a 12. But then once we determine what the supplies are, we debit supplies expense and credit supplies. So supplies was on there as an asset with a balance of 5,000. The adjusting entry gets it down to 2,000. So the purpose of the adjusting entry is to move the supplies from what we had it on the books for to what it is now. Then we're going to debit supplies expense, and that's going to go at the bottom of the trial balance, and it's going to be on the income statement as an expense. So if we don't make that adjusting entry, we don't have all our expenses recorded, and therefore, with all our expenses not recorded, the income is going to be overstated. Any questions on that one? Are there any questions? Okay. Let's move on to our B students, A and B students now. Talk about insurance. If you got a car, most times you got insurance on it. And in business, we're going to insure our assets. Insurance, it protects us from losses. So, and it's just, let's assume that we buy a 12-month policy on April 1st for $24,000. Okay. So on April 1st of this year, we paid $24,000 for a 12-month insurance policy. So we buy the insurance, we're going to debit prepaid insurance and credit cash. So we always kind of make this entry, okay, when we buy insurance. So sometimes, you want to debit insurance expense. Well, when you first buy it, it's not an expense. So we debit prepaid insurance and credit cash. Now, when December 31st rolls around, how many months are there from April to December 31st?
Nine.
Fine.
Okay, that's 9 months if you count April. Now, if you paid $24,000 for 12 months, how much of this insurance is expiring each month? If you paid $24,000 and insurance is expiring in 12 months,
2,000.
$2,000 a month. So when we get to December 31st, we had $24,000 in the account. So the monthly amount, 2,000 divided, 24,000 divided by 12 is 2,000. 9 months have expired, so 9 times 2,000 is 18,000. That's the adjusting entry. Debit insurance expense and credit prepaid insurance. And we have a balance in the account of $6,000. And 18,000 is insurance. So we had 24,000 on April 1st. When we get to December 31st, 9 months are gone. So the first thing we do, we divide the total cost of insurance by the number of months to get a monthly amount. If it was a 6 month, we'd be dividing by 6. If it was 24 months, we divide by 24 to get the monthly rate. Then we multiply the number of months expired that year by the monthly rate to get our AJE of 18,000, and we make this entry. So you're told what the entry is to buy the insurance. You aren't told what the AJE is. You got to calculate it. Any questions, A and B students, on that? No questions. Okay. So let's move on. Extraordinary A student. Long-term assets like autos, equipment, and building. They're prepaid expenses also. But now different when an asset is long-term and it expires, we're not going to impact that original cost. That original cost is always going to stay the same, and then we're going to put another companion account on the books to show how much is expired. So let's look at how we're going to do this. We buy an auto costing $30,000. We paid $3,000 down, and it had a useful life of 4 years. So when we buy that asset, we're going to debit auto, credit cash $3,000, credit note payable $27,000. Any questions? We debit auto. And let's assume we got it at the first of the year. It's a 4-year life on it. And so if we buy something for $30,000 that's going to last 4 years, the depreciation rate is going to be $7,500 a year. That is the car is going down in value. When you take the car to the car lot, it goes down in value. So when you buy a car for your business, it's going down in value. It's not worth $30,000 after the first year. And so therefore, you gotta depreciate it and reduce the value. So we're reducing the value. The AJE we're gonna make is what? We're gonna debit depreciation expense and credit accumulated depreciation. We could credit auto, but we want to keep this $30,000 on the books. So we put it in accumulated depreciation, which is what type of account? It's a contra asset account. And therefore, it's going to have a credit balance. It's a contra asset account, and it's going to have a credit balance. So on the balance sheet, A and B students, we show the equipment less the depreciation, the net book value. So similar to that bad debt, where we subtracted that from the receivables, for the plant and equipment, we're going to always keep the $30,000 cost. And then we're going to subtract the depreciation, so the net book value is $22,500. So we got 3 accounts now. We don't just have 2. We have the auto, we keep it at that value. Then we keep track of the $7,500 that's accumulated to have an expense of $7,500. How did we get the straight line cost? We just took the life, divided by 4 years. That's really a rate of 100%, 4 years. So the straight line rate is 25% of cost. So 4 in the 30 is the same thing as 25%. Sometimes we like to write off more, so we use double declining balance. So whenever we use the double declining balance, instead of 100%, it's 200%, and we divide that by 4 to get a 50% rate. So I'm just sort of talking about that a little bit now. We'll go back to it, but in case you're reading ahead and everything, so you'll be familiar with that. Okay, any questions? Any questions before we go on break? Okay, well, let me see. After the break, we're going to be on 23 and 24. No, I guess let me go back up. Let's see. 22. So 22, 23, and 24. So see, students, y'all decide who's going to work what. Y'all get ready to work those after the break. So after the break, we'll start on those and we'll go to others. So we'll just take our time on it. Well, why don't we do it this way? Just 22. So all C students, you're to work 22. So A students, you work 22, well, A and B students. And you do 1 and 2. So you got to do 22, then 1 and 2. These are our A, B students.
Can you show 22 again real quick?
Okay, I'm going to go back to it. So, and then that's enough. That's enough. So I'm going to leave 22 up. We'll take a break, and then we'll come back and look at adjusting entries.
It's on 23.
22 here. Can you see it now?
Yeah.
Okay. Okay, so how are we coming on journal entries today? How are we coming on journal entries today? So when we have a situation of earned income, when we have a situation of earned income, the journal entries are always going to be look like this when we're working with AJE number 2. We had a preceding entry, then the AJE itself. So we know what the journal entry is, we just have to figure out the amount. So in 22, if 1,000 customers pay $50 for NBA 2K18, what's going to be the journal entry to get the cash? How much cash are we getting?
50,000.
Okay, so thank you, C student. So all we did was multiply 1,000 times 50, and we got 50,000. And then it says 900 of the customers picked up the game. See, the thing that happens, everybody won't pick up the game. Okay. So what's our adjusting entry going to be for the 900 customers who picked up the game?
Is that 45,000?
That's correct. So all we're going to do is debit cash 45,000, credit sales 45,000. That's an adjusting entry. So there's nothing special about these. Here you get the cash. Is this 18 right?
No, it's 20.
20, that's what I thought on those revised sheets when we put others in. So when you have unearned income, this is exactly how the journal entries are going to look. You have a 4 and a 20, you got to calculate the amounts. So that should not be that hard for people to do, correct? Good. Any questions? That is the easiest one. Hopefully everybody can do that. So see if we can copy this. Come in here somewhere. So we're gonna take these out. We're gonna go to AJE1. So now that was unearned revenue. Now we're going to prepaid expenses. We're going to prepaid expenses. Let me do one thing quickly. Is this chart of accounts for adjusting journal entries, is this in the handout I sent?
Yes.
Okay. So same chart of accounts, but what I've done with this chart of accounts is to show you what accounts are involved in each JE. So we got AJE1, it's going to be supplies, prepaid insurance, accumulate depreciation, and depreciation expense. So I sort of laying out here, if it's an AJE1, where the expenses are, or it could be a supplies expense for AJE1, or it could be an insurance expense. So I'm telling you, if I got AJE1s, where the accounts are. For AJE2, where are the accounts at? We just worked on it, unearned revenue. That is 305 AJE2. And the corresponding location is sales when we recognize the revenue. So as you work with this, you got this chart of accounts, and I've just laid out where each of the AJEs go. And here's a nice summary table where we looked at the types. And we had, first of all, the prepaid expenses. That's type 1. Then type 2 is the unearned revenue. In a type 1, there's a preceding entry, and then this is the entry you're going to make. In a type 2, you got a preceding entry also, but it's sort of laying out. So this kind of summarizes. And like I said, today we're just looking at 1 and 2. We looked at 2, the unearned revenue. Now we want to go look at some prepaid expenses. So we want to look at some prepaid expenses. So in 3.1, it says J.H.J. Roan Car Company purchased supplies on account costing $25,000. At the end of the year, supplies on hand was $5,000. Record the entry to acquire the supplies and adjust the entry required at the end of year 1. So can you all record the supplies?
Yes, for the first one, I put 2017, then I did 130 supplies, debited 25,000, and then account 301, accounts payable, credit 25,000 for account type 12. And then at the end of the 2017 year, I did a AJE for supplies expense of 687, debited 20,000, and then I credited account 130 for supplies for 20,000. And then I made a note that the balance for the end of 2017 was still $5,000 before I moved on to number 2.
Okay. So then, so we bought it, and then we make the adjusting entry. We debit supplies expense. And then we credit supplies.
Mm-hmm.
So we buy them, they're an asset. Once we use them up, they're no longer an asset. And so we have to make an adjusting entry. So we're going to, and how much was used up? 25 minus 5, the difference.
20,000.
Any questions on 2017? So how does this look in T accounts? So let's just see if we can copy this. Paste that here. Because you would be making these journal entries and then posting them. So that's supplies, and then I need a supplies expense somewhere. Let's see if I can come back here. Sell. We just put supplies expense here. So whenever we make an adjusting entry, we post it. So here we debit supplies for 25,000. And then, and of course, we'd be posting payable too. But then when we make the adjusting entry, we're going to credit supplies for 20,000. And of course, this is the supplies expense account. And it's going to have a debit for $20,000. Any questions? So we make the entry and then we post it. And so that we know that we got what?
$5,000.
So coming into 2018, we have a balance of $5,000. Any questions? So let's go to the second one. So let's see what's going to happen in 2018. And it says what? In 2018, the next year, they purchase supplies paying cash in the amount of 15,000. Then they purchase an additional 20,000 on account. Now we got to make that adjusting entry. The supplies on hand is 10,000, and you got to always keep in mind what you had in 2017. So coming forward from 2017, you have 5,000 in supplies.
Mm-hmm.
And then you're going to make two purchases.
Yes, the first one is in cash, so it'll be supplies debited 15,000 and then cash credited 15,000.
Let me get this over here. And we'll change this to cash. So two purchases are made. One is for what?
15,000.
And the other one is for what?
20,000.
So now we've got to put the 15,000 into our account. We already got 5 there, so we got to put the 15,000 in and the 20,000. Okay, so that's where we stand. So as we post these amounts, how much is in the supplies account now?
40,000.
20, 15, and 5, so we got 40,000 balance now. So before we make an adjusting entry, we just have to recalculate the balance, which is now 40,000. When we look up here, what does it tell us? What's the ending amount in supplies now?
10,000.
So it's telling us this balance in this account is going to be 10,000. So the supplies account is going to have 10,000 in it. So if the balance is 10,000 at the end of the period and we have 40 in there, how much is the AJE going to be?
30.
40 minus 10, 30,000. So we have to make an AJE in 2018. So we make the AJE and then we're going to go ahead and put 30,000 in the AJE. Then when we post that 30,000, okay, so let me go behind it. So this was 2017. Then we get to 2018. We get to 2018 then. We would go ahead and get that 30,000. And of course, we know at the end of 2017, a closing entry would have occurred. So you said another reason for closing entries. We got to get the expense for the right amount in 2018. So we would have closed this out, of course. Are there any questions? Okay. Everybody understand? That sounds good. A good time for a attendance quiz then. So the first thing I want to do is do 24. So work number 24. So everybody see 24? So everybody take a picture of 24, so screenshot of that one. So I want you to do 24. And after you do 24, I want you to come back and do 3 and 4. So do 24, then 3 and 4. '24, then 3 and 4. So I'll give you all, I guess about 10 minutes. think you're supposed to do 24, correct? So the accounts and types all stay the same. I just need different dollar amounts. So in 24, if 2,000 customers pay you $50 each, how much money did GameStop get?
100,000.
How much?
100,000.
100,000? Okay. And how many customers picked it up? 1,500.
So unearned would be 75.
75,000. Some smart students in here. Understanding adjusting entries. Wait a minute. 75,000. So hopefully everybody can do an unearned income type adjusting entry. Okay. The accounts don't change, just the dollar amounts. The types don't change. Okay, let's see. Go up here to 3 and 4, these supplies. And see how we're coming with supplies. So we did 1 and 2, correct? Now we need to go to 3 and 4 with supplies. So it says in 2017, what did we buy in supplies?
$15,000 on account.
Just so in 3, you purchased 15,000 on account. So what are we going? The debit is going to be how much?
15,000.
And the credit is 15,000.
Mm-hmm.
And what's our AJE going to be?
Supplies expense for 10,000 debited. Our ending balance going into 2018 will be $5,000.
Okay, so we had a 15,000 in here. We took 10,000 out for the AJE. And so that meant then when we went to 2018, we began with $10,000. So what happens in 2018?
Oh, in 2018, we're gonna purchase 2 different things. We're gonna purchase supplies with cash first for 5,000, and then we're gonna purchase supplies for 10,000 on the account.
So we got 2 purchases that we're going to put in here for 2018. How much was the cash purchase?
5,000.
How much was the purchase on account?
10,000.
So we then take the 5 and the 10 and go into 2018. So we had 5,000 and then 10,000. So right now, how much is in the account?
Wait, where did you get that 10,000 from above the 5,000? Because going into 2018, it should have been a balance of 5,000.
Okay, I just probably put the 5,000 in. So is this right now?
Yes,
Fine. Okay. So how much do we have in the account at this point?
20,000.
$20,000. But it tells us the balance is going to be what after the AJE?
$4,000.
How much?
4,000.
So after the AJE, supplies are going to have $4,000. So therefore, the AJE must be what?
16,000.
Any questions?